Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Auto tariffs are on the way. President Donald Trump imposes a 25% levy on all cars and parts not made in the United States. European Commission President Ursula von der Leyen says she deeply regrets Washington's latest tariffs as the bloc prepares its response. Plus, European leaders gather in Paris for a defence summit as French President Emmanuel Macron looks to marshal support for Ukraine.
A quick check on these markets here where you are already seeing the negativity, the tariffs really showing up in some of the pain, and you can see it concentrated in those German futures, really underperforming the broader markets, which are also very much in the red, down by 0.8%. One eye on the Japanese yen, though, which is seeing quite a bit of strength, also related to the tariff story. The idea that perhaps the BOJ may need to hike with this additional hit, that creating some strength in the yen against the dollar. The countdown to the opening trade starts right now.
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff. We start off with a 2.5% base, which is what we were at, and we go to 25%.
Good morning. This is going to hurt. This is going to hurt Germany in particular. Let's talk about facts and figures this morning. Good morning, by the way, Thursday morning. Germany exports more cars to the United States than anywhere else. Last year, 1 in 3 Porsches went from Germany to America. 1 in 6 BMWs went from Germany to the United States. This morning, as Kriti's already said, we are going to see a big reaction.
Yes, absolutely. And it is those companies that President Trump wants to force a behaviour change. He wants more manufacturing in the United States, and this is the way he thinks he's going to get that. So 25% tax on all of those cars sold in the States that are not made there. It's also on parts. It's a little unclear. Reporting seems to be evolving around USMCA and exactly what the plan is there, although some plan is apparently coming in the coming days and weeks. We saw some instant reaction in the aftermarket in US car makers. GM, Ford down. Asia car makers have been weaker as a result of this. So we'll look to see what happens in Europe. Stellantis, of course, in focus because of its exposure to Mexican manufacturing of Jeep, Sky, but you put our focus also on some of those other European names. Lots of questions coming out of this. Will other industries face specific tariffs? All of this gearing up to the implementation of these auto tariffs next week on April 3rd, I think, which is a day after April 2nd. Next week is going to be extremely busy on tariffs.
Absolutely. And it's just phase one of this whole deal, right? Because on the one hand, it's the full cars that are being tariffed. 1 month later, at May 3rd, it's the auto parts specifically. Guy was talking about the German kind of exports to the U.S. I'll give you another number here. 20% of all U.S. car imports come from Mexico and Canada. Even more are the car parts themselves. So now we're talking about math where you have to look at what the actual makeup of these car parts are in addition to the whole car that's being sold in the States.
Doesn't this just sound like inflation to you? American cars are about to become more expensive. Cars in America are about to become more expensive. Not only new cars, but what there will be, therefore, is a ripple effect into the second-hand market, the used market, which is what we saw during COVID. And that was a big part of the inflationary narrative that we had to deal with then.
Yes, absolutely. That does seem like you're right to point our attention to the secondary market. On the new cars, and I assume this is just new cars, President Trump is floating the idea, no details yet, of a tax break if you buy cars that are made in America. So whether that counters some of the higher prices that we might see in the United States, but it's a complicated dynamic.
So the timing is everything, though. Haven't we been talking about consolidation in the car space? The idea that there's more supply of cars in the world than there is demand in this world. I don't quite know how the math of that fits if you're starting to see more expensive cars in the United States, but there are some cross currents here in the auto sector. That's just one piece of the equation. The other, of course, is the wider tariff story. In addition to autos, that's just one example of the sectoral story. We're still talking about potential double-digit reciprocal tariffs on Europe specifically coming into next week. At the same time, I believe just about an hour or so ago, Donald Trump issuing a bit of a warning on Truth Social to the likes of Ursula von der Leyen and Canada as well, that if they do try to plan higher tariffs in response, Donald Trump will respond even more.
Or if they plan to help each other, coordinate some sort of effort to counter America, in his view, then that's what he seems to be taking issue with. I thought it was really interesting in our reporting as well that focuses on the fact that Maros Sefcovic, who is a trade commissioner, has been to the United States, has offered to buy more LNG, has offered to reduce taxes on industrial goods, tariffs on industrial goods, but the US is not minded to negotiate, in Europe's view, ahead of April 2nd. They want to impose these tariffs and then maybe there'll be conversation.
So when do we get the European response? The indications are that there's going to be a slight pause.
Waiting for next week, I think. Yeah.
How long does that last for, I think? How quickly could this story escalate? To your point about what is happening with Donald Trump this morning, he's trying to get his reaction, the reaction in already before there is a reaction to the tariffs that are going to be coming in, and they're not even in yet. So it's the speed at which this could change over the next few days, I think, could be extraordinary.
Yes. And I was reading if Europe tries to use its anti-coercion instrument, which sounds fabulously Brussels, if they try to use that, then that does require a lot of consultation, requires going to the WTO. They've used it already around steel and aluminium, I understand, but that is one lever that they could be looking to pull. But how quickly, to your point, can they do that is going to be important. But there are other things, quotas on imports, taking on big tech in Europe in some way, even US financial services mentioned in our story as a possible area of retaliation, so we'll watch.
Yeah, an area of retaliation. Go ahead.
Sorry, I'm just trying to think about the overlap between this and what is happening with Ukraine.
Yeah.
And you've got a whole load of leaders coming together today at the Elysee in Paris. What are they going to be talking about? Are they going to be talking about how on earth do we respond to this? You just kind of wonder what the conversation mix is going to look like in terms of this meeting. Ostensibly, they're there to talk about Ukraine. We saw yesterday, obviously, this meeting between Macron and Zelensky. There's a new French package coming through, just north of $2 billion that's been announced. There is an expectation that Europe is going to pull together. This is the coalition of the willing that Macron and Starmer are trying to gather together. But there's there's a lot of open questions here as to what can actually be achieved. There is significant room between the north and the south of Europe in terms of funding. There is significant, obviously, divergence within Europe, and we think about what is happening with Hungary here. There's significant divergence on whether or not troops will be put in place and what impact those could have. So many questions still unanswered. Europe is trying to catch up with events on the ground, trying to catch up with what is happening between the United States and Russia, but really struggling to do it. And you just wonder what progress can actually be achieved.
Yeah, absolutely. And you wonder what all that talk of a reassurance force, where has that got to?
That sounds fabulously Brussels as well.
Right. Well, where has that got to? How has that come up against reality? Because, of course, it's met resistance from Russia. Well, you would expect it to meet resistance from Russia, but also domestically in some situations, countries getting some pushback as to whether really boots on the ground from various countries in Europe will end up over in Ukraine. So we'll watch Paris.
Yeah, the timing is everything, though, because it's coming right on the heels of this grain ceasefire in the Black Sea, which is technically progress from the United States front, but one that Europe didn't have a say in.
And technically also not complete, and nobody knows quite what's happening. And
the Russians still saying they are only saying yesterday if there is some lifting of sanctions, including possibly SWIFT. We spoke to Scott. We heard from Scott Bessent yesterday saying it's too soon to talk about allowing the Russians back into SWIFT. So where does that leave the Black Sea peace deal?
A lot of uncertainty, and I'm not sure necessarily that today is going to provide a great deal of clarity, but we hope. Let's talk about some great guests we've got coming up, which we're going to talk to, try and kind of progress some of these stories and get a greater understanding of what is happening. Sikander, Rashid, Brookfield's European head, is going to be joining us. We're going to talk infrastructure. That obviously is part and parcel of what we're talking about in terms of the rearming process that we are seeing here in Europe. We're going to talk to markets with Karim Chedid, BlackRock's head of EMEA investment strategy. Marcus Garvey's going to be joining us, Macquarie commodity strategist. What is happening with copper? Look at the copper price in the United States. Look at what is happening with gold right now. We'll try and tick all those boxes a little bit later on. We are, though, leading up to a conversation a little bit later on the show, which I think a lot of people are going to be interested to listen in on. Rachel Reeves, the UK's Chancellor of the Exchequer, will be joining this programme. We think circa 8:40. She's on a building site in Wales. There's probably a little bit of timing. My experience of building sites is that timings move a little bit, having worked on a few in my time. But looking forward to that conversation a little bit later on. The speculation this morning is about tax rises. She hasn't left herself enough room for manoeuvre. Tax rises are coming. Which tax rises are coming?
Yeah, absolutely. So this just points us to the next fiscal event, which will be the autumn once again. We've spent the last 6 months since the last fiscal event, since the budget, talking about, well, she's really not left herself very much headroom, so what's going to have to change? And we're just going to spend the next 6 months doing exactly the same thing.
Feel like it,
we're going to be asking about headroom, asking about whether there's going to be tax rises for sure.
Well, tax rises, but also how does she respond to the tariff announcement of the last 24 hours as well? Because it's not the UK isn't the main auto supplier, but certainly has exposure to the auto tariffs as well. Is that something that she has to bring under her wing?
In theory, her fiscal headroom can be blown up by next week. Tariffs could blow this out of the water.
Yes.
This may be a very, very small piece of headroom and a very short-lived piece of headroom that she currently has.
Yes, indeed, and that reference is, of course, April 2nd and the big tariff day that we're all focused on the very specifics around cars. 10% of UK auto exports do go to America. And to your point about some of those higher value cars, maybe... are they less interrupted, perhaps, by tariffs? I'm not sure, but it is some of those that we're talking about.
1 in 3 Porsches go. I wonder how many Aston Martins go. I imagine quite a few.
Yeah.
This is the investigative research we need on this show. You mentioned the levers Brussels could pull. Tech regulation is a big one. Digital services taxes right here in the UK against American tech is another. Let's talk about what else is going to be on the agenda in terms of the data that we need to keep an eye on. Less than 2 hours away from Euro area M3 money supply. If you're worried about the liquidity story in this part of the world, this is the data set you want to keep an eye on. 9 a.m. UK time, that is going to be hitting at the same time as the Norges Bank rate decision as well. So perhaps likely a comment or so on that energy exposure out of Norway as well. And then the focus shifts to the United States. At 12:30 p.m. UK time, get U.S. initial jobless claims. And 4 hours later, some commentary from Fed speakers, from the Richmond Fed President Tom Barkin. And then, of course, the highlight of the day, I would say, in Europe. And that, of course, is what comes out of Paris and the coalition of the willing summit, I'm told it's called.
How willing will the willing be, I think, is a key question around that summit. Let's talk about some of the other stories we're watching this Thursday morning. China has told state-owned firms to pause new deals with businesses linked to Li Ka-shing and his family. This after the Hong Kong billionaire upset Beijing with his plans to sell 2 Panama ports to a global consortium led by US firm Blackrock. Sources tell us the directive only impacts new collaborations, not any existing tie-ups. President Donald Trump says he would consider reducing tariff rates on China to secure a TikTok deal. He added that he would be able to obtain at least an outline of a deal for TikTok by next week. Any agreement would require approval not only from President Trump, but also from TikTok's parents and, of course, the Chinese government. And Bloomberg has learned that OpenAI is close to finalizing a $40 billion funding round. It will be led, we understand, by SoftBank. According to PitchBook data, the deal would be the largest funding round of all time. The funding would set a value of OpenAI at around $300 billion. The interesting thing about this is that even at this elevated valuation, even with this new money coming in, OpenAI is spending really aggressively at the moment on capacity, and actually in terms of kind of when we're going to see a cash flow positive story for this firm, it's still some way in the distance. So yes, the valuation is going up and up and up, but partly because it just has such need for spending at the moment on key capacity in data centres, etc.
Yeah, so cash flow positive 2029, to your point, is the date that they put on that. It really is interesting to see the spending need that they have here. I am intrigued by, linking it to the valuation, intrigued that in the period that we talked so much about DeepSeek, and many were surprised at how quickly the Chinese are competing on the AI front, that we have such a jump in valuation. That was interesting to me, the fact that it has nearly doubled just since October last year.
It's fascinating as well because this is a capex-heavy industry, and yet the markets aren't treating it that way. When you look at these massive tech valuations in the private sector like OpenAI, or even in the public sector with Microsoft, Google, Oracle, etc., but it is still very much capex heavy, and there is a question here of when does that come to fruition? When is the reckoning? When is the investment going to bear fruit?
Well, two points. One's to Anna's point, which is it does look as if the Chinese are trying to drive down costs and basically commoditize this market using the open source model, and it's going to be interesting to see how OpenAI, etc., responds to that, like the clues in the title in some ways. That's going to be quite a competitive space that they're going to be operating in. To your point about the data center stuff, look at what Microsoft is doing. The news this morning about potentially pulling back on investment in data centers. How soon is the day of reckoning going to be upon us?
It's fascinating because the critics of that, who are ultimately looking and saying, oh my gosh, Microsoft's panicking, they're pulling back on these massive spending, would say, well, Microsoft approaches AI and CapEx spend the way that they approach hiring, which is that they overhire and then they pull back.
And I saw another headline said they're spending more on data centres in Japan. So there we are. But lots to talk about with Brookfield, who I know are very interested in data centres. So we'll do that later in the programme. Coming up on the programme then, the retailer H&M reporting a miss in first quarter operating profit. What on earth is going on with this retailer? We'll bring you the details as we look ahead to the opening trade. Plus, we'll take a closer look at commodities. Traders race to ship copper to the United States before President Trump imposes import tariffs on the metals. We were talking about this with Will Kennedy yesterday. What happens to the copper that's in transit across across the Atlantic when those tariffs come in, if they do. Up next, we'll be joined by Tannenbaum, Chief Economist at Northern Trust. What impact do the auto tariffs and the tariffs of next week have on the US economy? If you want to get involved in any of those conversations, IB plus BBTV Go this Thursday morning and every morning. That's how you get in touch with the team that puts together this programme. This is Bloomberg.
I would be wary of assuming that the impact of tariff increases on inflation will be entirely temporary, or that a look-through strategy will necessarily be appropriate. I would be especially vigilant about indirect second-round effects on inflation.
We are all trying to figure out how this is going to work, what effect it's going to have. The Fed is obviously struggling as well. Every economist, I think, out there is struggling right now. Let's set this up and try and figure out kind of where we go next and our level of understanding. Valerie is here for a market reaction to the tariff story and where it takes us. Val.
Guy, the FX market is trying to figure it out as well. Seems quite a muted reaction to the FX market. Maybe that's because we're seeing not just the tariffs coming from the U.S., but all these retaliation measures kind of muddling the picture of what the FX reaction should be. It's all over the board here. Dollar CAD slightly stronger. The euro slightly stronger. The biggest mover is dollar MEX, but only 60 basis points for an EM currency really isn't that big. But maybe then the next chart, I can show you one reason why perhaps the Mexican FX is a bit more worried about what's going on. It's because the Mexican economy is way more exposed than anyone else to these auto imports. This is just the auto imports. If you add auto parts, the Mexican number is off the charts here. So perhaps a lot more at risk for the Mexican economy. But we can't take our eye off the EU. That's number 2 when it comes to exposure, especially from those German automakers. But another thing, Guy, I want to mention is we are in the back foot when it comes to momentum for the U.S. equity market. Trading a bit flat overnight. S&P futures just holding on to slight gains. But yesterday we did close below the 200-day moving average for the first time in 2 days.
Yep. The market definitely paid attention to that one, and we watched what happened with tech stocks as well yesterday. Valerie, thank you very much indeed. Tannenbaum, Chief Economist at Northern Trust, sitting around the table with us this morning, joining us from the US. Nice to see you.
Good morning.
How much do you know and how much do you not know at this point? We've got a series of tariffs coming through. It's quite granular, and I'm wondering kind of how quickly you can adapt your models to get a clear view of what this is going to mean for the US economy and more broadly for the global economy.
At the outset, I need to dispossess you of any notion that as an American I have any more information than you might.
What about as an economist?
As an economist, perhaps a little bit more. We do try and maintain contacts to understand how this is going to filter through, but the changes are coming so rapidly, and some have a lot of granularity, some have very little. Overall, it's terribly difficult to come up with a conclusion. The other thing I would note is that the uncertainty itself is pernicious to business activity. Instead of thinking about making investments or looking forward to new markets, American businesses, as well as those here, are turning inward, trying to figure out whether the supply chains that they built so carefully over the years are still going to work.
Given all that uncertainty, how big is the risk of a recession? This is the conversation that I keep having with people, and nobody seems to be able to kind of have any degree of clarity at the moment. Is that risk growing at the moment? How substantial is it now? How quickly are we potentially progressing towards it?
Well, if you're referring to the United States, our forecast has been downgraded, but we're still in the 1.5% range for real growth in 2025. The downside risks, though, are substantial. And certainly some of the new tariffs and the reciprocal tariffs that have been promised for early April will impair American companies. For other countries, Canada already has as its baseline a recession, and I'm very worried that other countries will fall into that same category.
Carl, good morning. Tell us a little about how you're thinking about inflation. We were just throwing around the autos story and what that's going to do on the inflation front, but more broadly, it seems like 101, a lot of people have been worrying about inflation on the back of tariffs, but Scott Bessent says, well, that's just mechanical, but then there could be secondary effects. But then there are a whole lot of other things moving around in the US economy. Higher prices might lead to lower demand. I wonder where that leaves your inflation expectations.
Well, first, Anna, I have to tell you, economists are strange people because we think about prices differently from normal people.
Okay.
To an economist, if a price doubles and stays there, eventually we have no inflation. It's what we call a level change. And so if that's the case, then central bankers, among others, are encouraged to look through that because long-term inflation is unaffected. But the data, the history, and the scenarios seem to suggest that this round of tariffs is so broad and attracting so much retaliation that it will be much more persistent. In addition, as consumers pay higher prices, they may raise their inflation expectations, walk into their bosses' offices, demand raises, and then the prices of the goods and services they contribute to will also go up.
And we have seen some inflation expectations on the rise, and some economists take that very seriously, and some kind of dismiss it and suggest actually it's not important, partly for the reasons that you suggest, that there's just a level change on the back of a tariff, and that's not persistent inflation. So are you concerned about inflation expectations?
I am. The evidence is mixed. Some are survey and some are market-based, and they're showing different signals. But all of them are ticking up uncomfortably, especially in this environment. And the Federal Reserve was pressed at its meeting last week to decipher all of this, and they were accused of pulling together Team Transitory again, which was the error that they made in 2021, assuming inflation at that time wasn't going to last. So I wouldn't want to be a central banker at the moment.
No, tough gig.
Is there a rationale, however, for insurance rate cuts the way there was the first time around under Jay Powell?
In different markets, the impacts on growth and inflation will be different. Right now, the impact on American growth is more modest than it is for many of the other centers. And so the Fed is more likely to be focused on inflation as opposed to diminished growth and employment, which is the case in Canada and may soon be the case here in the UK.
So perhaps more reactive than proactive. Talk to us about the fiscal policy going back to Donald Trump here. The argument with the Trump administration is that there may be short-term pain, but an extension of the 2017 tax cuts and further tax cuts on the horizon will offset the impact of tariffs domestically and for the budget as well. Is there merit to that argument? Does the math add up?
I'm glad you brought that up, Kriti, because we're focused so much on tariffs. There's another big event going on in Washington. It'll play out over the next 6 to 8 weeks, which is negotiations over the reconciliation bill, which will include potentially tax cut extensions. But the rules also call for those to be offset to a certain degree by spending cuts. So while we think it will be moderately stimulative, it may not be as stimulative as the administration would like. It may not be enough to offset the headwinds that the tariff battle is going to create.
So where does that stimulative impact more? So, for example, does it show up in spending? Does it show up in business activity in terms of tax cuts? Where do you see the positive impact of that, if there is one?
I suspect that the tax reductions or the sustenance of the existing tax reductions would work through the consumption channel. Businesses at the moment are facing, let's face it, tariffs are a large corporate tax on importers.
Yep.
And the uncertainty is dampening their business investment, which is a big contributor to GDP. So if the consumer can't carry the United States economy through, business is not going to be able to pick up the slack.
What does a bear market for U.S. stocks mean for U.S. consumer spending, do you think?
Wealth effects on stocks are well established. 2.5% to 3% is usually the number. But in a significant downturn, certainly the psychology of this could get away from us very quickly. You've seen the data both on business and consumer confidence in the United States.
Yep.
The mood, which was ebullient right after Trump got elected, is moderating.
All right, Carl Tannenbaum. We covered the gambit in just a very short amount of time. Northern Trust chief economist joining us around the table. We look forward to having you back again. Coming up on the program, we're going to talk about spending of a different kind, this time in the AI space. Do the monumental valuations you're seeing actually add up, and what does that mean for the investment in Europe? We're going to have an exclusive conversation with Sikander, Rashid, head of Europe over at Brookfield Asset Management. That conversation next when likes of Microsoft, Google, Oracle, and of course the public markets very much in focus, plus the defense sector as well. We're going to dive into all the details next. This is Bloomberg.
Welcome back to the opening trade. 30 minutes until we get a session in Europe that could look a little bit like this. DAX futures down by 1.1%. CAC futures down 0.9%. We're expecting some significant weakness across European equity markets. This is quite a European phenomenon because actually the Asian equity markets have stood up quite well in the face of the tariffs on the auto sector that have been announced by the Trump administration. And US futures are pretty flat. So we will look to see how US pre-market develops with the auto names specifically, but the auto sector in Europe certainly in our minds as we look at these futures and what we expect for the European session ahead. Let's have a quick word on the bond markets because we've also seen some slightly better news coming out on the French budget side of things, at least the budget deficit, not as much as the market had previously expected. A red headline confirming that earlier across the Bloomberg terminal. Has that moved markets? Well, we see that yields are a little bit lower in France. They're a little bit lower across Europe. So perhaps that is helping the mood there. Perhaps we're just seeing money go from equities into bonds, and the movement into bonds is not to do with the French story, but it could just be the risk story around cars. Kriti.
You're not seeing that big of a spread difference between France and Germany off those deficit numbers as well, despite the fact that we're expecting this massive kind of infrastructure investment from Germany. Let's continue with that theme if we can. Talk about not just infrastructure investment in Germany, but broadly, and not just in defense, but in AI as well. We have the perfect guest. Sikander Rashid, head of Europe over at Brookfield Asset Management, joins the program this morning. You're the perfect guest to talk to about this because we hear so much about the massive valuations in the public markets in the States, how excited everyone is about AI, how scared everyone is about DeepSeek. Where are we in that life cycle of AI?
Look, first of all, Kriti, thank you so much for having me. It's great to be here. Look, as you said, there are a lot of headlines out there, some positive, some negative, some neutral. I will simplify the story in 3 simple points. The first point is artificial intelligence is not expected to be, we believe it will be the most transformational general purpose technology of our lives. The big difference between AI and any other general purpose technology we've seen in the past is its ability to add economic productivity. So whether it's electricity, semiconductor chips, computers, in the past, AI is differentiated because of its ability to add that economic productivity. That's the first point. The second point is innovations like DeepSeek and Mansu that you just referenced. I think these are much needed. What we have today, whether it's your Netflix account that's recommending shows to you, or whether it's your autopilot for Tesla that can drive you from point A to point B, it is artificial narrow intelligence. For us to get to AGI, artificial general intelligence, where computers are as smart as human beings, a lot more innovation and compute is required.
A bigger impact than the internet?
Yes, because of AI's ability to add, to automate.
Is it comparable to the internet in terms of the effect? The internet was transformational. And the reason I asked the question is that with the internet, we went through a boom-bust cycle before we had clarity on where the value lay. And I'm wondering if you see something similar now in terms of a lack of clarity at this point as to ultimately where the value will lie in this process.
I think, Guy, what's different relative to the internet is at the time of the dot-com bubble, there was a lot of speculative capex that was invested. Today, that is not the case. In our business, at least, we are investing in assets, whether it's a renewable power business or infrastructure or data center business. We are investing in assets that are contracted. We are investing in assets that are located in good markets. And that is, I would say, the difference between...
This is a dead cert. Sounds like it.
It does. So Sikander, when you see headlines like TD Cowen's research on Microsoft saying actually they're going to, next fiscal year, they're going to pull back a little bit on the amount they're spending on their previous plans on data centers. They're not going to focus on construction. They're going to focus on the kitting out inside. That's just bumpy roads. That's just fluctuations along a clear path to you, is it?
Yeah, I think that's right. Look, the reality is, Anna, we've been in the business for a very long time. We've been building and operating renewable power assets for decades. We've been in the data center business for 10 years. We've seen this movie before.
Certainly.
Apologize.
We are going to fix the technicals in just a moment. But in the meantime, Sikander, let's talk a little bit about the resources required.
That's never happened before.
I know.
I've been doing this for a long
20
time.
years?
I can't
Never
remember
happened.
that happening.
Okay, well, that was a first.
A little bit of voice of God. Maybe AI can help us with something like that in the future. Let's talk a little bit about the inputs here. Because one of the big concerns is you have all this investment coming from the hyperscalers, but you don't have the energy, specifically in Europe, to make that possible. Where does the energy come from when we're talking about a shortage of gas, a shortage of oil, not as much nuclear power available to us? How do we deal with that?
Yeah, look, that energy is the bottleneck today. The answer is behind the meter solutions. So I think over time, whether it's solar or wind or nuclear, data centers will move to where the energy is. Our announcement in France is a perfect example of that. So what differentiates France from any other country in Europe is the country's access to clean nuclear power. The country has 15 gigawatts of excess power. These electrons can be consumed locally, and what better way to use them than to use them inside of data centers? And France also has a leadership that has the vision to compete with the U.S. and China when it comes to AI.
It's interesting that you're talking about France because of the energy perspective and not Germany, because that's where more arguably of the fiscal spend is. You're talking about a 20 billion euro investment in France. Germany, by comparison, not with Brookfield, but has talked about 500 billion and is talking about transitioning empty car plants to things like defense, but other power sources as well. What does Germany need to make up that gap?
Yeah, look, I think France and Germany are close allies. So France's vision is to become the AI hub for artificial intelligence for all of EU, and Germany will be a beneficiary of that.
How do you think about, how much visibility do you have on that at the moment? Just give us a sort of sense of where your conversation is around this process of European rearmament. It's happened relatively quickly. Obviously, the German government came in not promising to do this and has completely pivoted to do this in terms of the spending we're going to see out of Berlin. How evolved is your thinking?
Yeah, look, Guy, what I would say is what's happening today is most governments around the world have realized that AI is a tool to do two things. One, to stimulate the economy, and number two, to solidify the defense systems, including cybersecurity. China and the U.S., 30 years ago, this was an economic race. 15 years ago, it was a technology race. Today, it is an AI race. So whether it's France or Germany or Canada or Australia for that matter, I think each sovereign government's realized that it is important to compete with U.S. and China. It is important to have sovereign compute, and that will drive a lot of investment both in Germany, France, and the UK for that matter.
You're obviously very, Sikander, you're obviously very keen on this theme around and infrastructure is your thing, and within that, data centres clearly a big area of focus. I'm told, though, that the fundraising environment for infrastructure funds broadly is not quite what it was a few years ago. We're not seeing the big fund launches that we saw just a few years ago. Have investors already got enough of this stuff or gone a little cooler on these themes, do you think?
I don't think so. In the last 3 years, we have raised some of the largest funds in the world. We raised our infrastructure flagship fund, which was $30 billion, the largest infrastructure fund raised ever.
And you haven't seen a dip in that?
We haven't. We're raising our second transition fund. We haven't seen the dip. We haven't, at least.
So we've talked a little bit about fundraising. We talked a little about the AI grid. We talked about energy as well. Walk us through your thinking around the defense sector specifically, and I'm going to bring it back to Germany, but perhaps other parts of Europe as well. That feels like it's having more momentum in Europe than even the AI build-out. Where does Brookfield stand on the defense sector?
Yeah, look, it is. You're right. Historically, the European countries have only spent less than 1% of their GDP on defense. That is obviously changing on the back of the geopolitical backdrop. It's a sector we have studied very carefully. We have been studying it for a while. There is a huge opportunity to play. Where we play it exactly is something we need to figure out. But I agree with you. This is a big sector.
But do you still see that AI is the bigger place for value add than defense in Europe, or vice versa?
I believe it is AI, and the reason for that is the way we think about the investment landscape is just total capital required to be invested in a particular sector. And when you look at AI, that number today is $7 trillion. I don't think we have comparable numbers for defense. Our business today is $150 billion of artificial intelligence infrastructure assets. AI is such a large investment opportunity. If we are able to capture just 5% of that, it will more than triple the size of our AI business, and that is what's really exciting.
Well, we look forward to seeing whether that plays out, because the markets right now are pricing in the opposite. The defense is the juicier bit than the AI space, at least here in Europe. Sikander, Rashid, we look forward to having you back for an update, perhaps, on your calls. Head of Europe over at Brookfield Asset Management, joining us this morning, Guy.
OK, let's carry on the conversation around defence. More than 30 European leaders will be meeting today in Paris. They will be discussing support for Kyiv, including plans for a, quote, reassurance force of European soldiers stationed in Ukraine. This comes after the French President Emmanuel Macron said Russia would not dictate conditions for peace in Ukraine.
Russia shall have no right of say regarding the support we are providing and will provide Ukraine, nor shall Russia set the conditions for this sustainable, lasting peace, because it is about Ukraine and it is about the security of all Europeans.
The conversation carries on today. We have a wider meeting that is taking place. Ollie Crook, Bloomberg's Ollie Crook, is at that meeting. Ollie, what can we expect to come out of today's event? What should we be looking for?
So, Guy, we should probably mention what this summit actually is, because every single week we seem to be at a different sort of emergency summit of different EU leaders. So this is the sort of format of the Coalition of the Willing. It is taking place here at the Élysée Palace in Paris here, headed by Emmanuel Macron, a format that was really sort of brought into existence by Keir Starmer and Emmanuel Macron. The issue is with the so-called Coalition of the Willing, its broad mandate is very clear. It is all about reassuring Ukraine, bringing more financial and military support to Ukraine, but really actually to defining willing to do what is not something that they have done so far. The idea that we're trying to get out of this meeting and what we're watching very closely for is to get actual concrete numbers in terms of possible deployments of troops for a sort of post-war or a peacekeeping scenario that is sort of buttressed by those European powers, basically trying to bring that to Donald Trump, saying that, listen, we won't have to rely on the United States for these security guarantees. Here is what Europe is willing to offer. The issue that you have here is that there's a lot of reticence from a number of these so-called willing nations in terms of what the function of these troops actually would be. That has not been clearly defined. I spoke to the Lithuanian president last week. He said that they're actually coming with a concrete number of troops that would be willing to sort of be active in Ukraine afterwards. But again, even some of the more hawkish sort of countries that have been most supportive of Ukraine, you think of the Germans, you think of the Polish, this is not a done deal. So listen, for them, they need to get on the same page in terms of what these sort of countries are willing to offer, bring that then to the president of the United States. But the real question is that maybe Russia will not be able to dictate the terms of peace and the European support for Ukraine going forward, but the United States very well could, and that is going to come down to Donald Trump and sort of what his agreement or his understanding of his agreement is with Vladimir Putin.
Yeah, so President Trump not there, of course, Oliver, but clearly his presence being felt on the subject of Ukraine. No doubt the leaders who are gathering in Paris today will also be slightly distracted from the Ukraine cause, thinking about what's going on with tariffs. And Trump's auto tariffs just fresh on the wires just last night. And I wonder whether lots of side conversations are going to be going on around that subject.
Absolutely. And I mean, Trump is here basically in spirit, as he has been at every single one of these summits since basically Inauguration Day, and probably before that, basically forcing all of these European leaders into action. In terms of what the response is going to be on tariffs, they're taking a slightly more wait-and-see approach. I mean, we had a couple of statements out from Ursula von der Leyen and a few other EU officials saying that basically they will take a firm response, but they're not actually sort of deploying the tariffs right away. We understand that the Trump administration was basically unwilling to begin negotiations with European partners, we should say, I don't know if that's quite the right word, until basically April the 2nd, when these tariffs begin to come into force. And the Europeans basically need to be in a position where they're willing to be sort of strong and firm, while at the same time basically not unleashing all-out sort of trade war. And that is the sort of issue that you have before these European leaders who are trying to appraise what the sort of right sort of comeback is to the tariff issue in the United States. I think one of the biggest concerns for them, though, is how expansive the Trump view will be in terms of trying to right the balance economically. There is the question of the trade balance on goods. Does that take into account services? Of course, the U.S. runs a surplus on services. You don't hear that in the conversation. But again, I think what concerns them the most is if he starts to target things like VAT, the value-added tax, and other parts of the sort of economic balance where he tries to basically funnel all of that into tariffs. How the Europe is going to respond there is going to be a totally sort of open question. And if he does win concessions, will he then go further by enlisting some of these other things like the VAT and value-added tax? That, again, is one of the big questions for the European leaders. But maybe that's a problem for next week, and they'll focus just on Ukraine today.
Absolutely. Looking forward to seeing what comes out of that summit. Bloomberg's Oliver Crook for us live in Paris. We thank you so much. Coming up on the program, as Ollie said, Trump very much in focus. President Donald Trump signing his auto tariffs orders, German cars and other stocks to watch coming up next. This is Bloomberg.
Welcome back. This is the opening trade. We are just 12 minutes away from the opening trade. It looks as if we're going to see a negative session for Europe, driven largely by auto tariffs, now set to be imposed next week by the Trump administration. Let's get a perspective on global markets now. We're joined by our Markets Live executive editor, Mark Cudmore. Mark, in terms of risk sentiment then, this seems to be falling in Europe more than elsewhere. Asian equity markets, yes, there was some impact from the cars headlines, but not to the extent that perhaps we will see in European markets. I guess that makes sense. What are you watching for in terms of how this story flows around the world?
I think that theme of Europe taking the brunt of the pain is going to continue into next week. I think there's two aspects of that. I think one is the messaging very much is that this April 2nd Liberation Day, as Trump has called it, is going to be focused on reciprocal tariffs. And that seems like it's going to be very much focused on the EU. And even if the sector ones come in beyond autos, then there are ones where Europe is very relevant. So I think EU will take the brunt. And the second part of that is that, of course, European markets have been big outperformers for much this year. So they can give back some room while staying in the longer term positive story. I think what's really important is that next week is going to add some clarity, probably not full clarity. So short term, it'll be negative for vol. I expect vol to peak out in the middle of next week and then subside afterwards. But we're going to have longer term uncertainty because we're not going to get complete clarity, and some of these tariffs will be imposed as a negotiation ploy. So I think it'll be a low volatility risk negative event. We'll need to pick winners and losers. It's a time for active managers, but I think Europe will probably take the brunt of it at a bigger picture level.
Mark, why do you think next week delivers some clarity? It feels like it just opens the door to less clarity. We don't know how Europe is going to respond. We don't know how others are going to come back. We've already seen this morning Donald Trump warning that there will be further escalation if others do respond. Doesn't this just increase the speed at which this story is going to evolve and therefore increase the level of outcomes that we could potentially be looking at, increase, not decrease, the certainty?
So, very good question. So what you're going to see is you're going to see a steepening of the vol curve. So you're going to see near-term volatility come down. It is a little bit bid for next week. It's actually not massively bid into next week, but because we'll get some idea of exactly which tariffs are going to be imposed next week and some kind of messaging around what the steps are for further tariffs. And we'll probably get some further guidance about what the response rate will be. At the moment, we've got very little clarity. So we're going to get a little bit of clarity, but you're right. Long end vol should actually increase, and this is why I think you're going to see a steepening of vol curves. You're going to see near-end vol come lower and long-end vol rise, and that'll be the same across equity markets and in FX markets. As people say, the range of outcomes broadens, and I think that there remains that large uncertainty. So yes, it's a negative event, but short-term it should be slightly lower vol than we're thinking at the moment, where we have no idea what's going to be imposed or the tariffs. Most people haven't even worked out, and I include myself in this, are they going to get announced on April 2nd to be going to effect April 3rd? Like the auto tariffs are going to affect April 3rd, or are they actually going to affect April 2nd? So there's really no clarity at all at the moment on the dates, when things will go into effect, what they'll go effect on, what the response will be. I think what's really interesting overnight is how much coordination there is in response. What was, Trump has even kind of flicked at that, the idea of Canada and EU combine against them. That's where he knows he's really vulnerable. If the rest of the world starts collaborating in their response, that's when the outcome in the US will be even more negative than it's going to be over the long term.
Bloomberg Market Live executive editor Mark Cudmore with his analysis. You get more up-to-date from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro. Our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we're watching the auto stocks at the open of trading, given the news on tariffs coming from Trump overnight. Specifically, these are the ones that Morgan Stanley was saying we should be watching. Stellantis, Porsche, BMW and Mercedes, the companies with the biggest exposure to the US, and also with some production in Mexico crossing into the US border, so therefore really in the eye of the storm in terms of those tariffs. We can see a bit of a mixed year to date in terms of the performance for those, but all of them are called weaker this morning by the market makers that I've seen. Then in terms of retail, it's a mixed couple of updates. H&M looking very, very weak according to analysts. They expect downgrades to consensus estimates given the softness in the sales and a lot of discounting as well at the company. But here in the UK, Next looking strong once again on both clothing and home, and Next, as always, has the potential to read through into the other UK retailers. So we're going to keep an eye on the peers like the Primark owner, AB Foods, Marks & Spencer's, JD as well. All of those could be in focus. Then the owner of San Pellegrino, Nestlé, the water business of that company, could potentially be sold. This is according to a Bloomberg report, with private equity companies looking at that business, the water business of Nestlé. Now, this has always been a pretty strong and stable stock, but it has seen a bit of a weakness over the past couple of years, given worries about trading down in some of their key products. Potentially, this might be a little bit of a positive boost, but obviously with a market cap around 200 billion, it would be pretty small for that company. Then in terms of analyst ratings, a couple of punchy ones to bring you today. We've got ING as a buy at Goldman, but we've got Bank of America. We did have a rating on that one at UBS. They are downgrading that one to underperform. But the ones on the screen here, BASF, cut to underweight at JP Morgan. That one should be weekend. Air France, another sell. That one at Deutsche Bank. Could be softer in the airlines today.
Joe, thank you very much. So we'll keep an eye firmly on the auto sector. Yep. H&M could be weak as well on the back of those numbers.
Lots of ex-dividends today as well in the market.
Yes,
so just
plenty.
like huge numbers of ex-dividends that we need to be factoring into our thinking. It's interesting this morning as well. We are seeing ECB cut expectations growing on the back of the tariff story, which I think is fascinating. Is it inflationary? Is it a growth hit? Kind of how that balance evens out, I think, is going to be fascinating.
Well, I also wonder how the defense sector shapes up if we have the summit happening in Paris as well. Is this something that does actually show up in the markets? Is something you even trade pre any sort of announcement? That's the conversation we're going to have next. It is the opening trade. Risk sentiment is lower. This is Bloomberg.
Thursday morning, good morning. A negative start for European equities. Anticipated tariffs, a big part of that conversation. But it's not the only part of that conversation. We've also got weak consumer stories that we need to fold in as well. Take a look at H&M. This is the background. This is the legacy out of Wednesday. Europe initially moves lower, then basically just drifts sideways throughout most of the session. Similar kind of story, actually, to be honest, over in the United States. I'm not sure there's a clear steer coming out of the US session that we can take forward into today. There's been a lot of news evolving during that gap between the two. Obviously, significantly, the comments that we've seen around auto tariffs, what Trump has said this morning, all of that needs to be folded into the European session this morning. And Kriti, it doesn't look pretty.
It doesn't look pretty. The sell-off continues, at least that's what the futures are indicating. But you're already seeing a sectoral and a regional difference. You mentioned the tariffs, the auto sector, of course. What is the number one economy in Europe that's exposed to that? It is, of course, Germany. And you are seeing that reflected in the futures picture. Anna, down 1.2%, the clear underperformer of the session.
Yes, indeed. So does the pain in the auto sector, does it fall mostly in Germany? We'll also be keeping an eye on Stellantis, of course, because of its exposure to Mexican production for its Jeep brand. Let's have a look at some of the sectors that could be in focus. Autos is certainly one of them, so that's a focus. We'll certainly be watching the German market, all those automakers there and elsewhere around Europe with that in mind. Retailers in focus as well. H&M, fairly gloomy story coming out of them. Next, on the other hand, a fairly positive story coming out of that UK retailer, which will set the tone for the retail space, which will have more impact and read across. And Nestlé in focus, we already knew that they were tempted, that they were thinking about options for the water business. So our story then setting out the various private equity names that could be interested in taking that water business off their hands, Guy.
Okay, let's talk about the opening trade. It is almost upon us. Let's give you some numbers, give you an idea of how negative the open is going to be. Germany could take a few minutes to open this morning. I suspect the car sector is going to be responsible for that. The FTSE 100 is already negative, but isn't expected to bear the brunt of what we're going to see today as a result of the tariff story. Still some read across maybe out of what the Chancellor had to say yesterday. But as Anna says, next could be a big story in the London market. The 600 is down, roughly in line with what the FTSE 100 is down, unsurprising at this point. The IBEX now opens. We factor that into our thinking. It is down by 0.6%. I'm going to pause here. The CAC is open. Actually, that's happened relatively quickly, a little more quickly than anticipated. It's down 0.8%. But I suspect there may be a small hiatus now as we await the arrival of Germany. Kriti.
Absolutely, Guy, and the breadth of the sell-off is quite large. I think that's the kind of takeaway that I'm seeing this morning, because when you look at the downside movers, at least from an index contribution perspective, it is still your heavyweights. It's still like the SAP. You're still seeing a little bit of healthcare and tech in there that is on the back foot. Your outperformers are a lot of your kind of safeties that we traditionally tend to look at. Your likes of Unilever, for example, the consumer staples that we see, even utilities having a moment in the sun, but again, against a very, very weak backdrop. So that's going to be something that we are keeping in mind, Anna.
Yeah, it is a sort of, it's a classic risk-off session in some senses, isn't it? Money's going into supermarkets and places you have to spend money rather than into the places you might choose to. Autos and auto parts is the worst performing sector. We don't have the German DAX open yet, but all indications are that that will be weaker. Actually, the autos is not the weakest now. Banks now the weakest, down by 1.1%. Now, is that to do with shifting expectations around the ECB and whether this is then sufficiently growth negative that we get more rate cuts, and whether that's negative for the banking sector? That would seem to be something of interest. But we don't have opening prices on all of those crucial German automakers. Looking at Mercedes, at Porsche, at Volkswagen, at BMW, Continental, nothing yet.
There are some divvies in the market. So Roche on my board shows us the biggest drop. That's mechanical. That's dividends. So don't be confused by some of what we're seeing today. A huge number of stocks going ex-dividends. So we just need to kind of be aware of that peripherally, just to kind of think and figure out what is happening here. But yeah, car sector. This is going to be interesting. What are we going to be watching here?
The car sector, I'm still keeping my eye on the defense sector as well. So really, Germany very much in focus in 40 seconds time or so, maybe a little bit longer, as Guy and Anna mentioned. Let's get a little bit market analysis in the team. Meantime, Karim Chedid, head of EMEA investment strategy over at Blackrock, joins the program. All right, Karim, I feel like every time you're on, we get a tariff headline. So you are...
That's every day, isn't it?
I think it's easier to say Karim is the tariff indicator. How do you play a market when... one, you have tariffs that are this nuanced and this sectoral, but two, you don't actually know what comes next in a couple of days' time?
Sure. I'm not sure I signed up to get this title from you today, but when we're looking at digesting this policy uncertainty, you're right. I mean, there is this, if we zoom out, there's this idea that we have protracted policy uncertainty. The longer it's protracted, the more it would have some downside risk on growth expectations. But on the bigger picture front, we do expect that the tariff headlines, the negotiations are around the 20s, 25%, but we see the longer-term landing rate as around 10%. And the quicker that we move on from these headlines, the more transitory the impact on inflation. So that's really the trade-off. But to be clear, we don't expect recession risks to be very high in this environment. We don't see any signals of recession risks in Europe or the US.
So when you see a market like this, where Europe is looking at these auto tariffs and it's selling off, what is it reacting to? Is it you said it's not recession risk. Is it reacting to a lack of pricing power? Is it reacting to inflationary risk from a consumption standpoint? What does the sell-off mean to you?
To me, it's a near-term sell-off on policy uncertainty. And here is where we need to really focus on the fundamentals. So some of the sectors that you spoke about opening in the red this morning, whether it's defense, autos, banks, I would differentiate between these sectors. On the banks front, for instance, I hear Anna's comments about the ECB rate path, but we do see the profitability outlook for European banks as remaining quite resilient. And importantly, even if the ECB is likely to continue to cut rates, which we think they are, to a terminal rate of around 2 or just below, we don't see that as negative for the banking profits. It's very different to the previous regime of sort of zero or even negative interest rates. Whereas for autos, we see the profitability outlook as a little bit more challenged for that sector. So we do prefer the banks over the autos. The defense sector, we're seeing significant demand come from investors. We've seen flows into our defense ETFs, for instance, for the reasons around the German package. And this could still have some legs.
You don't see any recession risks at this point?
I mean, we need to look at it regionally. In the US, earnings are still very, very strong. So from a corporate perspective, we're no longer at 16% earnings growth for S&P, but we are at 10%. We're still in double digit in terms of the Bloomberg consensus of analyst expectations. Then you look at other parts of the economy. We have some weakness in consumers. Yes, the retail sales figures have come in a bit weaker. But a lot of this is weaker versus expectations. So you look at the economic surprise index, and that looks quite negative for the US because the data rolled over versus expectations. But the absolute level of the data is still firmly in expansionary level, that we don't see it as, of course there's always a tail risk, but we don't see it as a base case.
What's your degree of certainty at the moment? Because Kriti was joking coming in. The story changes by some significant magnitude every day at the moment.
Yeah, absolutely. And this is why, I mean, we do have a fatter tail risk for all assumptions at the moment. I think you'd be hard-pressed to find two economists on the street with the same inflation or growth forecast for this year. To your point, there is a diversity of views. That wasn't the case last year. Last year, there was a lot more consensus of views. So how do we invest in that? From a whole portfolio perspective, how do we position our portfolios for such an environment where we're still pro-risk, we're overweight on stocks, we like stocks in the US, we see a second leg in the European rally, but we also have a lot of risks. We put a fatter sleeve for diversification in things like gold and market-neutral hedge funds.
Karim, let me just emphasise what we're seeing in markets this morning then with these auto stocks. Autos and parts down by 3% now. Some of the big names within that sector over in Germany under pressure, as you might expect. We've been talking about some of them already. Stellantis, so not Germany, but down by 5.5%. Valeo, Mercedes-Benz, BMW, all of those down by more than 3.5%. So substantial weakness. But away from the day-to-day drops then, we spoke to a guest from UBS earlier this week who said net-net, they are assuming, they think that, this was Jerry Fowler, that they think that the negatives from tariffs are going to be less than the positives from all the fiscal spend coming through in Germany and the fiscal boost that will bring and where that goes in the economy. Do you broadly make that same trade-off, that same comparison?
So when we look at it through the lens of Europe, the first leg of the European rally in equities year to date, obviously a big regional outperformer, global outperformer, has been really to do with sentiment, with reduction in geopolitical risk premium, and the tariff headlines were not really priced in. So seeing days like today where you have some near-term volatility on tariff headlines as we approach the April 2 date is to be expected. But yes, I think on aggregate, the positives that are coming from this sort of huge moment in Europe where we finally have some unlocking of fiscal spend, that it's not all going to go into European growth upside. Of course, some of it will spill over to US growth upside, the European spending, because the order books of European defense companies are already full. But nonetheless, it does present net more upside.
So are days like, well, maybe not specifically today, but days where we see stocks under pressure because of tariffs in Europe, are they buying opportunities then?
I mean, that's where that's the conclusion we're getting to. I think there are buy on dip, good entry point opportunities, especially if you focus on the strong fundamentals. We're also seeing some money in motion come back into European equities from very under-owned levels. Let's not forget, we had a couple of years of really strong US flows. Year to date, we're seeing buy on dip in US equity ETFs as well, but no doubt Europe just had a record month in March in terms of ETF flows, and that can continue.
In terms of how you're thinking longer term, not just kind of the immediate, let's call it 0 to 6 months, longer term, Are we going to be more diversified geographically going forward? Has the period of US exceptionalism come to an end? Do I need to think about a more balanced portfolio geographically going forward from here?
I think it all comes down to knowing where the strong fundamentals are. It looks a little bit different. So on the US side, yes, of course, it will still be a very important market. We remain quite positive on the stock market there, but the leadership is shifting a little bit. I mentioned the earnings 10% figure for S&P 500. For equal weight, that's 7%. So the gap between the mega caps and the large caps that are not in the top 7 or top 10 has shrunk, and we expect those fundamentals to continue, the gap in those fundamentals to continue to be smaller. So we position in things like S&P equal weight ETFs. When we look at the rest of the world, yes, I think the gap is also likely smaller. Look at it through the lens of artificial intelligence. We're seeing the narrative shift from just the picks and shovels of AI to more of the AI adopters, where rest of the world equities can also benefit. So more in Europe, more in the rest of the world.
Quite a big portfolio shift going forward. Karim, great to see you. Thanks very much indeed for dropping by to see us. Karim Chedid, Head of EMEA Investment Strategy, joining us from Blackrock. Quick look at the core six. There's only one auto stock in the mix here. Let's see how Ferrari is dealing with the story this morning on tariffs. Not as bad as some, but still down and down reasonably hard. That's probably a pretty big export market. If 1 in 3 Porsches went to the United States last year, how many Ferraris went? We are seeing pretty much weakness across the board. Interesting to see there is some safety maybe being priced into Nestle, even with the water story to factor into our thinking. Joe Easton, what do you got?
So the auto sector, Guy, really the focus of the market at the open of trading. Weakness across the board, including the auto manufacturers, also the suppliers as well. But in terms of those key movers, the most exposed to the US, Stellantis dropping around 6%, Porsche coming down 4.5%, BMW, Mercedes also seeing similar drops on news of this 25% tariff on goods sold in terms of auto sold in the US, and those are the companies with the most exposure. So seeing the biggest losses, clear red on that screen at the moment. Then a sector that's doing pretty well is UK retail. This after Next once again boosts its guidance. They are seeing diversified sales according to the analysts over at Bloomberg Intelligence, and they reckon that also that overseas sales doing well as well. And we're seeing a lift for the UK retailers, the other peers, Marks and Spencer's, AB Foods, the owner of Primark, also getting a bit of a boost. Next does tend to be a bit of a bellwether for that sector. Then the retailer not doing so well is H&M. Continued guidance downgrades, no improvement in the trading outlook according to analysts today, and that hitting that stock at the open. It's actually come up a little bit to where it opened, but it is still pretty much a big underperformer on the retail sector given the movement in Next. Then in the media space, we've got ProSiebenSat, now the company getting a takeover offer from a broadcaster linked to the Berlusconi family in Italy, but it is at a big discount to where the stock traded yesterday, and really disappointing markets today, disappointing investors on the amount that the company is going to get for that bid. So that is a big dropper over on the German market today. Then in terms of the analyst ratings, the banks are underperforming today. Some of that seems to be driven by UBS as Bank of America goes underperform on that one. This is all related to the capital regulations that are being changed over in Switzerland, specifically for UBS, and Bank of America is saying that this uncertainty is going to weigh on the company for much longer, so they go underperform, recommending selling shares of UBS this morning. That's hitting that stock significantly, down 5% today. And finally, another downgrade was Air France. Deutsche Bank says that the entire airline sector is facing more geopolitical and macroeconomic headwinds. So it's a broader story around the airline industry. But one sell they have is Air France, and that one is falling 4% in Paris trading this morning.
All right, Joe Easton from our equities team, we thank you so much. As Joe's walking us through those early movers in the European session, we are also getting early movers in the U.S. pre-market session as well. And as you can expect, you're already seeing quite a bit of pain when it comes to the auto space. General Motors down a whopping 7% in the pre-market. Ford as well on its heels, about 5% circa. Tesla as well. We know Elon Musk has made some comments on X over the last 24 hours saying that Tesla is not exempt from the tariff impact there. Those shares down about 2.3% as well. So you really really want to keep an eye on those. The chip stocks are moving quite a bit as well, Anna, so that's going to be one that we keep an eye on.
Yeah, absolutely. Watching the automakers then stateside and those chip names, as you mentioned, Kriti. Here in Europe then, 14 minutes into our European trading session, and we're certainly keeping retailers in mind. Coming up, retail divergence as H&M reports a big miss. The stock down heavily at the open, but now pulling back from some of those earlier losses, down by just 1% now, whilst Next has boosted its outlook and boosted its share price by the look of things, up by 8.3%. That's next. This is Bloomberg.
Thursday morning, good morning. We're 18 minutes into the equity market session. Germany is taking a big hit. The reason for that, well, unsurprising. The auto sector is down and down hard this morning. Overnight, we have seen the announcement coming through when it comes to the tariff narrative that we have been so long expecting. Europe is under pressure as a result of this. Let's show you some numbers and give you an idea of what the stock story looks like in the auto sector specifically. Think about it. 1 in 6 BMWs comes out of Europe, goes to the United States. It's the biggest market for Germany, export market for German autos in the world. Interestingly enough, the UK is the second biggest market, but autos are down and down hard this morning. Let's get some details on what we know, what we don't know. Michael Dean, head of Global Autos for Bloomberg Intelligence this morning, joining us around the table. You've had a busy night. Do we have the clarity, though, that we've been waiting for? Do you have the clarity you've been waiting for?
Not the exact clarity, but we do know for sure that European automakers are going to be hit by 25% on top of the current 2.5% tariff for imports from the EU. So this is going to have a massive effect on the likes of Porsche and Mercedes.
And is this going to be a lot of luxury cars we're talking about, or high-end cars? And how is the market going to respond, I suppose, to attempts to put up prices?
Yes, so the likes of BMW, Porsche have the ability to raise prices. And if you look at the imports from the EU for BMW and Mercedes, these are AMGs, these are M-series cars. Yep. So they could increase their prices by 25%. I'm not so sure. So there's going to be an impact. Ferrari better positioned than most. But even if you're buying a Roma for $200,000, are you going to pay another $50,000 on top of that, or will you choose an alternative vehicle?
So you know this quite well, in that the dynamic in the state, at least for Ford and GM, has largely been that 90% of the car, maybe that's not the right percentage, but approximately, is put together in Mexico or in Canada, and then that final assembly is put together in the U.S. and they get to stamp on Made in America because of that. How much of that process is subject to change because of this, and how quickly can they even make that change?
Yes, so we don't know exactly the process at the moment. And I spoke to Stellantis' CFO recently. He said a lot of the parts for cars made in Mexico and Canada come from the US. So there's a large offset there. So there's a lot of uncertainty at the moment.
In terms of what this does to the overall market, the question we're asking this morning is how inflationary will this be? How much do you think the average car in America, if there is such a thing, goes up as a result of this? How much does the pickup go up? How much does the secondary, the used market, change? Is this going to be another big inflationary push that we're going to see in the United States? Can you give us a sort of sense of the order of the magnitude?
So we think that cars, or the impacts of tariffs from Mexico and Canada, could increase the car prices by about $6,000 to $10,000. But
off a baseline of
$50,000.
Right. Okay.
But as we heard from BMW a couple of weeks ago, so they're already impacted by tariffs from Mexico into the US. They're having to absorb all those tariffs because they just feel they can't increase prices in a difficult environment at the moment. So I think about 50% of that increase will be pushed through, and luxury car companies or premium car companies will be able to absorb the other half.
That's interesting, because we've heard from a lot of the car parts makers saying they're just going to drop this right down to the customers.
Yeah,
they're not taking any of it. Was the line we heard out of a number of the German manufacturers and elsewhere, who make for the auto sector.
Absolutely, which brings me back to the point of, and I'm going to use a COVID example if I can. During COVID, when all of these supply chain issues were concerned, Tesla had outperformed at that time, and the argument was because their raw materials and their commodities and their supply chains were so close to their end factories that worked in their favor. Is that a model? Is that a roadmap for the way you navigate not only a supply chain crisis, but a tariff crisis?
Well, you've got to look at the reason why these tariffs are being implemented. And Donald Trump wants to have more production shifted to the US. And I think that's ultimately his goal. And we've got a whole weekend of negotiations to see what the EU will do, whether they're lower tariffs. So they currently charge 10% against the US charging 2.5% for car imports. But then looking at the likes of Tesla, they would be a beneficiary because they have a local supply base in the US. So yeah, that could be a model for the future.
I think Elon Musk was saying we will still be here, but your point being not as much as everybody else because of the manufacturing in the US.
Yeah, if you hear from the other manufacturers, they will say that Tesla has a lot of parts coming from Mexico. So ultimately it could be hit to an extent.
Are you hearing a lot of European manufacturers looking for sites in the States? I mean, President Trump likes to make this point. He says, look, these automaker companies, not necessarily Europeans, but they're all looking for sites already. It's already working. Is that what you're hearing?
Well, this is why the German automakers will be upset, because they are a big employer in the US. In a couple of years, with Volkswagen, BMW, Mercedes, they will be producing 1 million units. Half of those will be exported. They already employ 30,000 people in the US. So they will argue they have a big presence, and therefore it's unfair for these tariffs to be implemented.
OK, will it be big enough? We will see. Michael, thank you very much. Michael Dean from Bloomberg Intelligence with the latest on the autos sector. Now, Next, in the retail space, has raised its profit guidance as the fashion and homewares retailer said it can withstand growing risks in the UK economy. Meanwhile, H&M posted weaker than expected operating profit in the first quarter. The H&M share price clawing its way back to flat. The Next share price really on the rise this morning. Let's dive into these numbers. We're joined by Bloomberg's Jennifer Creary, who covers the retail space. Jennifer, very nice to see you. So what are the companies saying then about the outlook for the rest of this year?
Yeah, so two very different results. You have Next on the one hand, which has issued another profit upgrade. If you remember, cast your mind back over the past year, had 3 consecutive profit upgrades, and clearly it's pretty bullish for the coming year. All things considered, risks in the UK economy, we have rising minimum wage, we have a rise in taxes, but still the company believes that it can offset a lot of those costs. By contrast, there's H&M, which has had a relatively disappointing start to the year. So it missed analyst estimates for operating profit and net sales, and one of its biggest issues is inventory, and it's really hamstrung by that excess stock. And so for the coming year, it's gonna have some difficulty trying to claw its way back out of that.
Talk to us a little bit about how much this is perhaps a canary in the coal mine for some of the other retailers.
So with H&M, it's tricky in the sense that, it's a company that has a lot of exposure to swings and volatility in the global economy, particularly when you think about tariffs from the US, some rising costs in, shipping, raw materials. It's going to have a tough time trying to manage those costs. Next is a very different beast. It does have some exposure internationally. Something that was quite interesting was that it made a note about, although it has a very small business in the US, it's set up kind of a separate entity that will help mitigate some of the costs of the removal of the de minimis rule. So that's
small packages.
Exactly, right. And so, it is setting up some of those contingency plans in place for some of those rising costs kind of internationally.
What did they say? What did Next say about the uncertainty in the UK? We're going to be talking to the Chancellor very soon. I'm reading a note now from Shaw which talks about Next kind of defying gravity at the moment. There seems to be so much uncertainty around the UK consumer at the moment. How can Next be doing this when the UK consumer seems so vulnerable?
Yeah, Next is a famously cautious company, and because the costs coming in April is such an unknown for a lot of businesses like Next, they won't want to create anything they can't sustain. But clearly, they're very bullish about the performance, and a lot of that is to do with growth in their overseas business. Right. So they're able to offset some of those risks in the UK with the UK consumer kind of pulling back.
All right, Bloomberg's Jennifer Creary walking us through some of the stories in the European retailers. Anna.
We are going to be turning our attention to the commodities market. Coming up, we'll take a look at the copper trade that's heating up thanks to tariff talk. Marcus Garvey will be with us, head of commodity strategy at Macquarie. Today we're obsessed with cars. Yesterday we were obsessed with copper because our reporting suggested that a tariff on copper imports to the US would be coming sooner than many had expected. That has set a massive gap between London and US copper prices. As a result of that, an interesting conversation awaits with Marcus Garvey. Stay with us. This is Bloomberg.
This is the opening trade. We're at 30 minutes into today's session, and you are seeing red across your screens. Of course, the underperformer of the morning is going to be in the DAX. This really has to do with that reaction coming out of the auto tariffs in the States. But look at the rest of the benchmarks across Europe. You are seeing the same risk-off sentiment across the board from France and even right here in the UK.
Let's talk about the commodities trade. That's been a wild one over the last few days. The copper trade is just amazing. Gold price is amazing as well, but copper has been fascinating. Everybody's trying to race to ship copper to America before potentially President Trump imposes tariffs. There's a big gap, spread, divergence between therefore copper prices in the United States and the rest of the world. Let's try and figure out what is going to happen here, whether or not this persists, what the growth story looks like, and how that's going to impact the commodity market as well. Perfect person to talk to, Marcus Garvey, Head of Commodity Strategy at Macquarie. Marcus, great to speak with you. Let's start off with copper. Does the spread between US copper and rest of world copper remain? What happens here? What's your outlook?
I think the base case is it does remain, and actually it pushes a little bit wider on the back of tariffs being implemented, which is, given what we've already seen in steel and aluminium, the most likely outcome. But as you were talking about in the introduction there, there's a huge change in terms of the implications for price of going from this position of a risk premium, which is physically arbitrageable and is almost dragging all other copper indices, obviously principally the LME market, higher with it, as it's bringing demand forward as people want to buy copper as soon as possible to get it to the US. And the moment you have tariff clarity, whether that is a tariff and therefore there's a price difference but it's not arbitrageable because you're paying that tariff, or there's no tariffs and that price disparity moves away, suddenly you go from a very, very strong bid for material to go to the US to a dramatic loss of that demand because it's not increasing demand, it's bringing demand forward. And then also subject to what happens with the rest of the reciprocal tariffs, plus obviously the auto tariffs today, you're going into an environment where very arguably those tariff changes are net negatives for demand. So the scope for some pretty dramatic swings in price, and particularly the shapes of the forward curve on copper, I think are where we're sitting right now.
So behind this pull forward, so initially you get a pull forward, prices go up, but behind that there could potentially be a very big hole in terms of the demand story. How much volatility, therefore, should we see? How quickly do we switch from one to the other?
I think the key determinant of that is going to be where is underlying demand actually running once you lose this sort of excessive demand as a pull forward. And the real test of that is also going to be where's Chinese demand. Because if you lose this additional US bid, for anyone who's got sort of yet to be delivered to the US floating units of copper, where are they going to send them? If actually you find that the price drops a bit on the LME, for example, maybe it falls back to the mid-9,000s, and the Chinese price is above that, so that you get an opening of the import arbitrage to China, then maybe the market can clear without too much of a problem. But actually, if you find that that doesn't open quickly, then there's going to be people left with material that they may only really have an option to deliver it into the LME as the sort of market of last resort, at which point it could be much messier and you could see prices very quickly falling back to sort of 9,000 or even below that, and the spreads, frankly, collapsing.
Marcus, good morning. In amongst all of this dislocation then that you anticipate or could be possible, is China going to be left short of copper? Is that going to be a risk?
I think that's very unlikely, to be honest. If you look at where we are year to date, you've had a very normal seasonal inventory build in copper. And actually, if we look at how you're drawing that inventory build over the past few weeks, it's drawing in line or even a little bit slower than seasonally normal because of the fact, actually, that they're exporting a bit of material, is worth highlighting, and they're importing less than normal because it's currently more profitable for that material to go to the US. So if this goes on for a very, very long period of time, then you might get to the point that China starts to get a bit short. But if this closes within a small number of months, then I think that's not going to be the case, and actually they'll be in a pretty normal market environment.
OK, so China and the demand story there, crucial to the underlying demand story for copper, Marcus. Also crucial is perhaps the energy transition, because it's often cited as one of the important metals within that. And I note from your notes, you seem to have quite a lot of confidence in that still being underway. Colleagues have been looking, we've been so distracted by tariffs, we perhaps have not given enough focus to some of the environmental policies happening in the States. Colleagues have been tallying up 82 actions to roll back climate initiatives across 20 different government agencies since Trump took office on on the 20th of January. So how convinced, Marcus, are you about the energy transition and the impact that has on these metals?
I think the big uncertainty that's introduced by any changes in the US is more about what does it mean for demand in the US on, say, a 3 to 5 year forward view, whereas the implications for the next sort of year to 2 years are actually very minimal. And I say that both in terms of the US share of total demand for most of these metals and also the US share of change in terms of energy transition. So if we think about something like copper or aluminium, the US is less than 10% of global demand. And then if we put that in the context of something like the electric vehicles market, we think that this year globally, the electric vehicles market will grow somewhere between 3.5 and 4 million vehicles of additional sales, of which China will be a bit over 3 million. And then the US will probably be only a bit under 200,000. So even if you completely wiped out that US demand growth, you still have quite healthy underlying growth on the basis of what you're getting from China. And really, if we look at this year and next year, and even to a degree 2027, we think that China can carry most of the global growth in something like the electric vehicles market, especially when you factor in exports to other emerging markets in addition to the domestic demand. The big question mark on energy transition demand, though, is more, I think, when you look beyond that and you're reaching high levels of penetration in China, and then you're going to need the developed markets to really start to pull their weight, which would be the US and Europe. And that's a much bigger question mark, because for that to happen, I think what you really need to see is that the energy transition becomes commercially competitive in those markets, which it is not at the moment, whereas it is in China.
Marcus, it's Kriti in London. I'm going to bring it full circle back to the auto tariff story. If you were a trader, or if you're looking at flows here, where do you see more of the tariff story showing up? Is it in copper or is it in oil?
At the moment, it's much more in copper. I think one of the things that's worth passing there is if we look at something like copper, obviously aluminium, we've already got tariffs in place, and also steel. The thing that really has changed is you get a change in the US price, and the reason for that is because sellers have alternatives on where they're going to sell, and the US consumers, as a net deficit market, still needs to import. Even if you get marginal increases in domestic production, you can't get a dramatic short-term increase. And so that shows up really very, very clearly in a higher price in the US paid by the US consumer or processor. In oil, though, you have a big difference. I mean, at the moment, obviously, we don't have full implementation of the threatened tariffs on Canada and Mexico. But in that case, where a lot of Canadian energy exports that can only realistically go to the US, most of that burden conversely then falls on the supplier because they don't have an alternative in where they sell to. So that's quite a big difference between the two market structures in terms of who carries the burden and therefore where it shows up in the pricing.
Well, sticking with the market structure, you mentioned the Canadian energy infrastructure story and perhaps the exports that are hitting that market. There's another supply concern coming out of Iran. We had one of the major executives at Trafigura join the program a couple weeks ago, and he said that the unknown in the oil market is Iran and much less the tariff risk. Would you agree with that?
I think it's one unknown. I'm not sure we'd agree that it's the biggest. I think another major unknown is also what happens to Russian exports. It's possibly even more impactful than Iran. Because if you think back to after Russia's invasion of Ukraine, there was a big fear in the market that we would lose Russian volumes. And then the reality was that almost nothing left the market. But what we've just had is the wind down of the general license that enabled people to effectively still transact in Russian crude subject to the price cap. And how that gets enforced and what happens in terms of the broader negotiations between Russia, Ukraine and the US obviously is the main mediator there. You could have scenarios where you lost up to 2 million barrels a day of Russian crude. That's very much not our base case. But that is a tail risk that's worth bearing in mind when we think about potential disruptions to the oil market.
Marcus, how big are the tails at the moment? The commodities story is really interesting. It's part of a wider economic story. Every economist I talk to at the moment has a different view than the previous one that I spoke to. And it just seems as if the range of economic outlooks at the moment is absolutely enormous. Can you remember a time when it was this hard to predict what was going to happen next? And how are you, therefore, adjusting the way you're thinking about the market to that uncertainty?
Well, I think other than something like the height of kind of COVID uncertainty and initial lockdowns, no, to be frank. There aren't really that many comparables for the degree of uncertainty that we're facing. I think that there's two things, though, that we can do is accept medium-term forecasting, the degree of accuracy is not going to be particularly high given the amount of uncertainty, but we can at least make reasoned judgments on balance whether something is going to be a net positive or negative in terms of demand change, for example. And on that, I think tariffs and also countermeasures to tariffs are broadly negative, at least as a first-order effect. And then the second thing I think we can do is we can take a step back and look at where our market's currently tracking in terms of how physical balances are evolving, and accepting, well, if current run rates continue, and then look at degrees of change, what are you tracking towards? So I think if we were to go back to copper, some people are talking about a deficit market this year. There are plausible scenarios where that happens, but globally, last year we were in a surplus. Very hard to disagree with that because we had a visible global inventory build, so we came into this year in a surplus. And year to date, you've had a very normal inventory change. So it's very hard to argue that the copper market is in a deficit at present. That it might eventuate, but I think the base case, if we look at it, is it's not in one at the moment. Tariffs are going to be negative for demand. Once you get through this period of a pull forward from the US, albeit maybe that lasts the whole year, but once you get through that, actually you're looking at a market which is not likely, in our view, to be particularly tight. And it's trying to go through that rationalization process. I think that is what we have to stick to.
Great to catch up, Marcus. Always appreciate it. Thank you very much indeed. And the commodities market is used to a bit of volatility. Marcus Garvey, the head of commodity strategy, joining us from Macquarie. What are we going to do next? We're going to talk about what is happening in the UK. We are going to unpack what we learnt yesterday from the Chancellor of the Exchequer, Rachel Reeves. She is going to join us. She's currently in Wales. We're looking forward to that interview. It is coming up shortly. This is Bloomberg.
Welcome back to the opening trade. We're 45 minutes into today's session. We're seeing risk sentiment weaker across the board. Some real underperformance in the DAX. No surprise there. The markets in Europe certainly reacting to the auto tariffs placed over in the States overnight. We should also mention the FTSE 100 isn't selling off just as much. There is an oil component there as well, down about 0.7% though. So not exempt from the tariff conversation, but perhaps not selling off just as aggressively.
Let's talk about what happened yesterday in the UK. The spring statement from the Chancellor of the Exchequer, Rachel Reeves. The gilt market just about bought it, but there's not exactly a lot of room to play with here. If you are the Chancellor of the Exchequer, the fiscal budget buffer pretty much exactly where it was in October, and we know what happened after that. As a result of which, the UK the Chancellor now hostage to fortune. So many things happening around the world that could upend everything here and put the UK back in a bad place. UK correspondent Lizzie Burden joining us around the table. That's the problem here. She doesn't have much room to play with, does she?
No, she's saying exactly the same amount of headroom that she left in October that got wiped out. And that raises the question, if it gets wiped out before the autumn, what's she going to do? She's so wedded to these fiscal rules, she tells us. These spending cuts have been so politically toxic, it only leaves tax rises. And so there'll be months of speculation over which tax rises it will be. Now, when it comes to the headroom, again, Reeves yesterday made so much emphasis on the global headwinds that had caused the UK's economic woes, and she strongly hinted that they come from the White House. There's the question of what is she actively going to do to prevent Donald Trump whacking the UK with tariffs?
So not much contingency built in then, and tariffs are very much on our minds as we've heard overnight about auto tariffs. And we head into next week with a whole suite of so-called reciprocal tariffs. And the UK in talks, it would seem, with the United States on trade.
And really interesting that she hasn't ruled out scrapping that digital services tax. Would it actually be worth giving up a bit of the headroom if that's the price of shielding the UK from those tariffs? Interesting that, I know you were talking about this earlier, Maros Šefčovič has been, saying we'll buy more LNG. But that's not getting a lot of wiggle room for the EU.
Yeah, didn't get much in the short term, did it. We'll see what it delivers after April 2nd. Lizzie, thank you very much. Bloomberg's Lizzie Burden with a nice setup to our next conversation. Joining us now is the UK Chancellor of the Exchequer, Rachel Reeves. Chancellor, thank you so much for joining us. Let me come to you on the point around headroom then. We spent the last 6 months, the market spent the last 6 months, the UK media spent the last 6 months asking questions about what you were going to have to change in the spring statement because your headroom was being eroded. Given the volatility in the international environment, aren't we in danger of spending the next 6 months having the exact same conversation?
When I became Chancellor, I inherited a headroom of £6.5 billion. I built that up in the autumn to £9.9 billion. And despite what's happened to global borrowing costs, which of course has eroded our headroom in the UK, I built the headroom back up to £9.9 billion where I started yesterday. You ask about tax or spending decisions, but actually you miss a really important point, which is that by growing the economy, you can make the size of our economy bigger and also bring in more tax revenue. And crucially, the OBR did score yesterday the reforms that we've made to the National Policy Planning Framework, which they say by the end of this Parliament will mean the economy is £6.8 billion bigger than it otherwise would have been, and that will bring in £3.4 billion in terms of additional revenue. And so that is an example of how this government's strategy of going further and faster on delivering economic growth can both improve living standards but also ensure that we've got the money to continue to be able to meet our fiscal rules.
Chancellor, good morning. It's Guy. That is the more medium-term prospect that we are looking at. But let's return to the tax issue because that feels like it's the shorter-term story that we may need to focus on. Within weeks, you could see the fiscal space that you have eroded. That will necessarily start a conversation about how you, again, return to a position where the rules are going to be met, and that will return us to a conversation about tax rises. The speculation, Chancellor, has already started. Do you recognise, because you've only left us with a small amount of fiscal space, that there will be a conversation about tax rises and that there will be a cost to that conversation? People may be deciding actually to put off investments, to put off spending, because they are worried about the potential tax rises that could come in the autumn.
Well, we wiped the slate clean on the fiscal mismanagement and the fiscal fiction of the previous government last autumn. And we did have to introduce a number of tax measures then. But I was determined yesterday that we continue to meet the fiscal rules without further increasing the tax burden. And that's what I was able to achieve yesterday. But economic growth is an important part of this because economic growth means that there is more money coming in tax revenues and also that you're paying less money out in the system. So growth is absolutely essential for a strong economy, but also for strong public finances. And that's why we are redoubling our efforts with the Infrastructure and Planning Bill, which had its successful second reading in Parliament last week. It's why we are introducing the Pensions Bill next month in Parliament to unlock long-term patient capital as part of our capital markets reform. It's why the Prime Minister and me are embarking on a big regulatory overhaul, having got rid of 2 regulators already and reducing the admin burden of regulation by 25% in this Parliament. So we're going for growth because growth in the end is the missing ingredient in the last few years in the UK's economic policy. It doesn't just have to be tax and spend. A stronger economy generates the tax revenues that we need to fund our public services and also secure our public finances.
Chancellor, it's Kriti in London. Let's talk about the news of the morning to that end of where that growth comes from, specifically the news emanating out of the United States. You've previously said that the UK is not in a position to escalate tariffs against the United States. That being said, if it comes down to it, what levers can the UK pull?
Well, I believe in free and open trade. I believe it benefits countries exporting and importing. It keeps prices down for consumers and it offers additional choice for consumers and opens up new markets for businesses big and small. I do understand the concerns of the US administration about countries that run large persistent surpluses with the US. The UK, though, is not one of those countries, which is why at the moment the UK and the US, after Prime Minister Keir Starmer's visit to meet the US President a couple of weeks ago, we are now in intensive discussions with the US administration ahead of the increase in tariffs next week to try and secure an agreement. Those talks are ongoing. They will continue later today because we want to make sure that those trade flows between the UK and US continue to be strong. Trade between our two countries increased the last time Donald Trump was President of the United States, and there's no reason why that cannot be the same in this presidency.
Chancellor, you put the emphasis then on those trade conversations with the United States over the next few days. Why specifically are they so important? Are you anticipating any kind of exemption? So far, the Trump administration has not been keen to give the UK exemptions.
Well, we are in those trade discussions at the moment with the United States. They were willing and open to having those conversations with us. Those talks are ongoing. They'll continue today. Of course, trade frictions will make it harder to grow the economy. I don't want to see additional tariffs or any other sort of trade barriers. It's also why the UK and EU are having a summit in May to try and reset relations and reduce the costs of trade barriers between the UK and the EU. So on a number of fronts, the UK trying to support trade because we know it's good for business, we know it's good for jobs, and we know it's good for the bottom line for UK PLC.
Chancellor, is there anything you would be prepared to give up to do to make the White House maybe treat the UK in a different way? We were just discussing around the table with Lizzie the possibility of maybe scrapping the digital services tax. Would that be on the table? Are there other levers you could potentially pull? Can you take us inside the room and give us an idea of what is being discussed and what is on the table at this point to maybe see the UK get a different treatment to the one we are potentially going to see meted out to the European Union?
Well, at the moment, there are tariffs on the flow of some goods between the UK and the US, and those tariffs work both ways. I would like to see tariffs between countries fall. So, of course, we're having those conversations. Tax policy is one for national governments to decide. And, you know, we'll continue those conversations with the US. They're an important juncture at the moment, ahead of developments next week.
Rachel Reeves, the Chancellor of the Exchequer, thank you very much indeed for spending some time with us at Bloomberg this morning. What do we take away from that?
Well, I thought it was interesting that you asked, you know, do you recognise that there's a downside to all the questions being asked about fiscal headroom and questions being asked about tax? And she goes to the conversation about growth and emphasises that instead. Both could be true, though, that it could be right to focus on long-term growth, and also there could be a downside risk.
But in the short term, it's the downside risk.
Yeah.
In the medium term, it's potentially the upside risk. Lizzie,
what do you think?
Sorry, I'm bursting to tell you what I want to say here, which is, you know, she's relying on forecasts from the Office for Budget Responsibility, which is notoriously boosterish. And, you know, if the Office for Budget...
But she has to.
She does have to, but if, say, the OBR does the nightmare scenario for Reeves and downgrades its forecast in October, November...
Gone.
Yeah, headroom, gone. Nightmare scenario then. But also, if this is about credibility, if all of these painful welfare cuts were about sticking to the fiscal rules, and this is predicated on a forecast that is boosterish, how is that credibility?
It's going to be an interesting debate. Anyway, that wraps up the opening trade. Fantastic way to finish the opening trades. The Pulse is coming up next with Tom McKenzie. This is Bloomberg.